Valens Research, Uniform Financial Analytics.
Broadcom is a semiconductor manufacturing business. They merge with AVGO. They make a lot of things around, if you will, 5G, et cetera. They are a chip manufacturer, semiconductor company for communications equipment. And for Broadcom, the first thing that jumps out is really the first chart that we have here. And just to go back and understand what you're seeing here, whenever you look at a company in the Valens Research app, the first place we always bring you is to this tab here, the PVP chart. What does PVP mean? Again, like I said, we're very literal people here at Valens. PVP means performance and valuation prime, right? And what does that mean? It's because we're looking at the performance of a company and its valuation, and prime is because we're looking at the uniform accounting adjusted performance and valuation. Here, what you can see is when we talk about performance, we look at return on assets, right, which is a holistic way of understanding how good a company really is at generating profits. And we look at asset growth. How good a company is at really reinvesting in itself over time, right? And then for valuation, we look at valuations relative to assets, right? VA, value to assets, and we look at enterprise value relative to assets, which we can compare to a price to book traditionally. And we look at uniform accounting PEs, what we call VE prime versus a PE. So just jumping in, what immediately jumps out to us here is, wow, these blue bars are a lot higher than these orange bars. If you look, these orange bars are the as reported distorted profitability for Broadcom over the last 15 plus years. And you can see, we get as reported metrics for Broadcom, and you see a company with a 4% ROA. In reality, this is a company that doesn't have a 4% ROA. It has a 60% ROA, right? This is a massively profitable business, but as reported metrics tells you it's not making any money at all. Worse than that, as reported metrics tell you that returns have been fading since 2011, when in actuality, they've been improving. Right? Clearly, as reported metrics are misrepresenting this company's profitability. We can see the same thing, by the way, when we look at asset growth for Broadcom, right? The orange distorted as reported asset growth for this company says in the last 2 years, it grew by 35% and 12%. In reality, when we look at the uniform accounting data, we can see the reality is it really didn't grow at all in 2020, and it grew a lot slower in 2019. We're literally changing, by looking at the right data, how we think about this company. We were missing and misunderstanding how profitable this business was, but also how much it could reinvest in itself, looking at the as reported metrics. You can really think about these two metrics as almost a great and really simplified way to break apart free cash flow and look at free cash flow in a more holistic way. To look at it in terms of how much cash are you generating and how much are you reinvesting in the business. Because, right, there's this idea. People often focus on free cash flow and say, you want to invest in high free cash flow companies. In reality, you can have negative free cash flow companies that are great investments because they're making money, cash flow from ops is positive, but they're just plowing so much money into reinvesting in the business, right, that they're trying to grow the business, and those are actually great companies to buy, right? And so what we can see here, though, is, right, by looking at this, unlike what the as reported metrics would tell you, which is basically this company's free cash flow relative to assets is, right, negative 8% a year, because 4 and then 12, right, if we just net those two together. In reality, this company is throwing off $57, 57 cents for every dollar in assets, $57 in operating cash flow, less $1. So it's throwing off 56 cents of free cash flow a year. We can see that better and understand how the drivers are because we're looking at uniform accounting. Then our next question is, all right, but how expensive is it, right? How much is the market paying up for how good or bad it is? And what's really interesting is, right, you look at Broadcom on an as reported basis and you'd say, wait a second, a company that has a, right, 4% ROA, why is it trading at a price to book of 8 times? That makes no sense. If we got a low return business, it shouldn't trade at a premium relative to its equity. And similarly, it shouldn't be almost at market average PEs if it has declining returns. Well, it's only when we look at the uniform accounting we say, oh, you know what? It makes sense that this company trades at a premium relative to its assets because it has massive returns. And more importantly, since it has stable and improving returns, of course, it's trading at around market average valuations because the market thinks that that can continue, right? We can understand both the performance and valuation of a business. And the last thing we look at here is what we call TSR relative to the market. And so TSR, for those of you who don't know, is total shareholder return, the return of the company in terms of cash, in terms of capital appreciation of the stock any given year, and any dividends it pays. And then the return relative to the market, that second R, basically all that means is we're benchmarking. We're saying if this line is flat, that means the company's stock performed in line with the market. If it's rising, that means the company outperformed the market. If it's falling, which it barely did here, that means it's underperforming the market. And now intuitively, you would expect TSR, total shareholder return of a company, to track its performance, right? As a company gets better, stock should rise. As it gets worse, it should fall. And yet, if I look at the as reported metrics, just as TSR is taking off for this company, return on assets is falling. Why? Because the market doesn't pay attention to bad, garbage as reported metrics, right? The distorted as reported metrics the market doesn't pay attention to. Lo and behold, if I look here, look, as returns were rising, TSR outperformed. And right as returns continue to rise, TSR continued to outperform because the market's paying attention to the uniform accounting data, the cleaned up real cash flow generation ability of this business. But right, that alone isn't enough for us to say, do we want to buy or sell the stock? For us to understand if the company looks undervalued or overvalued, right? Not just is it good, but not just is it a good company, but is it a good stock? We then need to look at what the market's pricing in, what we call embedded expectations, and what a lot of the investment grades from Bill Miller to Seth Klarman to anyone else talk about is always understand what the market's pricing in first, and then understand if you think it's undervalued or overvalued based on that. And to do that, we can look at these bars that we haven't talked about yet, these light blue and white bars. These two light blue bars are what Wall Street sell-side analysts are forecasting return on assets and asset growth to be for the next 2 years when we take their estimates and we push them through the uniform accounting framework. The most valuable part of this chart, though, is these 3 white bars and these 4 white bars here. That's what the market is pricing the company to do at a $200 billion market cap and $475 stock price. So if you think that the company is going to have returns that are more stable than this is pricing in, well, you think the company's undervalued, right? And we can actually test this using the embedded expectation tool, which is a powerful tool that we give to you as part of having access to the uniform accounting database, to the Valens Research database. What we can do is we can open up this tool. Sometimes it takes a moment to load. And let's say, right, this company still has had returns improving over the last 5 years from, let's just take a low to a high from 49 to 57%. So let's say that we actually think that it can continue to improve, right? ROA can continue to expand. It's not going to decline. And also, right, these growth levels look pretty reasonable for this company. So if we want to look at that, right, once this actually loads, we can take that and we can put that into a scenario. And we can say, what does that mean in terms of what the stock's worth, right? Because this is telling us what the market is pricing the company to do, right? What are the embedded expectations for this company? But if I want to say, okay, this rose to 57, so let's say we can do that again. So we go basically up 8%. So from 57, we rise up to, right, 65. Let's solve for what the stock would be worth, right? Again, the wild thing is, if you were looking at this company on an as reported basis, you would have seen a company that was trading roughly around market average valuations with declining ROAs and weak ROAs. You would have even thought about, hey, what happens if this company continues to have ROA expanding? Because there's no way that you would think that ROA could expand, right? Because you already are seeing a company with declining return on assets. It's only because we're seeing the real uniform accounting data that we can actually see the reality here of what this company might be worth. And if we plug in this scenario, right, with 7% asset growth and 65% ROA, what we can see is this company, if you believe in this scenario, might be 40% undervalued. And yet, you would not even be having this conversation if you were looking at the wrong as reported metrics. And that's the power of uniform accounting.
Valens Research, the world's leading source for uniform financial analytics.